Okay guys, thanks for dropping by the channel. This video is about unlocking the true power of the health savings account. Now, to be fair, when it was first introduced, I was highly skeptical of it. Oh, here we go again, another government solution to the healthcare problem. But I think they may have actually got this one right. Health savings accounts are triple tax-free saving and investing accounts that are part of a high deductible healthcare plan. These plans allow you to save and invest for the future by getting a tax deduction now, tax-free growth, and tax-free distributions if the funds are used for medical expenses. Now, if you found this channel, I know you are concerned with where future tax rates are headed and how large a chunk of your wealth the government is targeting. Stick with me and we'll unlock part 6 of my 100% tax-free retirement strategy. Colin Exelby here, and I provide financial planning for business owners and their families that just makes sense. I own the financial advisory practice Celestial Wealth Management and provide advice virtually to clients all over the country. HSA, or Health Savings Account. Health savings accounts are triple tax-free saving and investing accounts that are part of a high deductible healthcare plan. These plans allow you to save and invest for the future by getting a tax deduction now on your contributions, tax-free growth if you invest the funds, and tax-free distributions if the funds are used for medical expenses. And if you stick around until the end of this video, I'll fill you in on a little known secret that can allow you to withdraw funds for any purpose. This is a good spot to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. All right, huge benefits there with HSAs and a key part of the 100% tax-free retirement income strategy. You know why? Not just because HSA distributions are tax-free, but because just like the Roth IRA distributions, HSA distributions do not count as provisional income and do not make your Social Security taxable. In 2022, a family can contribute up to $7,300 into an HSA and $8,300 if you're older than 55. If you're single, you can contribute up to $3,650 with an extra $1,000 if you're over 55. And there aren't any income limitations. The higher your current tax bracket, the larger the deduction that you get. If you have the receipt for the medical expense, you can withdraw funds whenever you like without taxes and penalties, no matter your age. Even later on that day, make a contribution in the morning, pull it out later in the day. Now, once you reach age 65, you can withdraw funds for any reason without penalties, but you still would owe taxes like any other pre-tax retirement plan if you didn't use the funds for medical expenses. Stick around and I'll fill you in on a little known secret that can allow you to withdraw funds for any purpose without taxes or penalties. All right, check this example out. Let's say you're named Ross Geller. You all know Ross from Friends. He's 30 and now he has a family. You have 35 years until he reaches 65. He decides to max out the annual contribution of $7,300 and the government never raises it. Let's also assume that he never puts in that extra $1,000 when he reaches age 55. So you just put in the $7,300 every year for 35 years. Let's also assume you invest the money in a diversified portfolio and net 7% a year. This is what that looks like. Your total contributions are $255,500. Your total gains are $824,277. Your total balance at age 65 is $1,079,778. And if you use that money for medical expenses, all of those distributions could be tax-free and penalty-free. If you use them for other expenses, you'd owe taxes, but not penalties because you're older than age 65. Now, I promise that secret strategy is coming. You know what makes me sad or really just a little frustrated? For many people who have HSAs, there isn't any growth. You might say, Colin, well, how can that be? Well, many people contribute to HSAs, but they miss the most important step, actually investing the money. According to a 2021 report by the Employee Benefits Research Institution, 50% of people employed have opted for a high deductible healthcare plan with an HSA. But only 4% of HSA accounts open for at least a year are investing their money. And after being open for 15 years, only 20% of those accounts are invested. What that tells me is that a number of people are aware of the tax deduction for contributing to it, but they aren't aware of the huge growth potential or just weren't told that investing those funds was even possible. It seems the vast majority of people contribute to the HSA, get the tax deduction, and then pull it right back out. Ah, man, if they knew. Proper planning can help you target a certain amount of growth in the HSA plan so that you cover your assumed health expenses in retirement. Once you reach age 65, you can withdraw the funds for any reason without penalty, but you don't want too much in there because if it isn't used for health care, you pay tax on the withdrawals like regular income. All right, are you ready for that secret strategy to completely tax-free withdrawals without penalty? Here it is. There is no time limit on when you can claim the reimbursement from your health savings account. Really? Well, currently at least, I can track my medical expenses right now on a spreadsheet, keep the receipts, and then claim them in a huge lump sum later on in life for whatever reason, because these expenses never expire. What type of expenses can you track? The list is literally endless. Here is a list that's compiled by HealthEquity. I'll provide a link to it in the notes below. Look at this as we scroll through here. AA meetings, antacids, Botox, condoms, crutches, eye drops, fiber supplements, gambling treatment, infertility, a midwife, and many, many, many more. Seriously, it's almost anything you can think of that's medical related. And you know what? When I make that distribution, it would be tax-free and would not count toward my provisional income. You remember provisional income, right? Provisional income is all of that income the IRS adds up to compute whether your Social Security income is taxable. Now, I would never tell someone to spend all their time tracking all their medical expenses and logging receipts through their entire life. But hypothetically, if you tracked every bill that was over $100, that might be a very good way to help your future self. All you would need to do is create a spreadsheet in Excel or Google Docs, somewhere in the cloud that's backed up. List out the date of the expense, what it was, what the cost was, and confirm that it was HSA approved. And like we said, almost anything is. Then upload an image of the receipt to the file and move on. Wow, that is an amazing way to maximize your future tax-free retirement income, and a secret strategy that many people don't know about. The key is to make sure that you track those expenses and don't include anything other than those medical expenses when you pay for things. Don't go to CVS and buy antacids and then put a Snickers bar on there too. That can void the purchase. You know what shouldn't be voided? This next video. You need to watch this next. You will want to know why permanent life insurance may be the key to your planning in the next 2 decades. Get clear, be clear.